Have you tried to sell options but got frustrated on how much money or margin or collateral that you need in your account? I mean, let's say you want to sell a Tesla option. You're going to need to either already have 100 shares of Tesla or be able to buy 100 shares of Tesla before you can even start selling options on it. And at today's price, that's about $100,000. And even if you're lucky enough to have $100,000, do you really want to risk your position just for a little income on one single trade? This is where credit spreads come in. In this video, I'm going to cover what credit spreads are, the different types of credit spreads, how to pick them, how to sell them, and of course I'm going to provide a lot of examples, and I'll also show you how you can generate monthly or even weekly income with credit spreads, and how you can find opportunities using an options screener. It's kind of like a search engine for options trades. And if that's not enough, at the end, I'm even going to give you my 7 rules for selling credit spreads. So stay tuned. By the way, do you think stocks are going up or down tomorrow? Let me know in the comments below and what you're going to be doing about it. Okay, so I wanted to give a big shout out to our sponsor for this video. It's Options Samurai. Options Samurai is a search engine for options trades. The system uses AI to scan the market for 22 different option strategies, like credit spreads, based on the parameters that you give it. The results are then displayed within seconds, and it gives you opportunities that you probably wouldn't be able to find by doing it yourself manually. Later in the video, I'm going to show you how I use Options Samurai to set up my search and find trades to generate income on credit spreads. Okay, so let's get started. Credit spreads generate income for the trader. It's a fantastic way for investors to make some extra money, and they work well even if you have a small account, or you want to limit the amount of capital at risk in a trade. In fact, with credit spreads, you can start trading with just a few $100s. And because of this, traders can take advantage of this strategy by selling tens of thousands of credit spreads with different underlying securities, strike prices, and expiration dates at any one time. Now, if you think that's cool, go ahead and give me a like on this video. A credit spread is a type of vertical spread, and there's 4 types of vertical spreads. A credit spread is where you sell one option and buy another with the same underlying security and expiration, but at a cheaper premium. In other words, there's going to be 2 legs to the trade, as each option is called a leg. The option that you sell is called the short leg because you're said to be shorting that option. And the other option is the one that you buy, well, that one is the long leg. The credit is the difference in the money between what you got on the option that you sold and the money you pay for the option that you buy. And that's where the name credit spread comes from. Let me give you an example. Let's say you wanted to sell a call credit spread, and the stock price is $500. And you decide to sell the 510 strike price and you collect $20. Well, this is your short call. Then, let's say you decide to buy the $520 strike, and for that you'll pay $8. Well, this is your long call. To calculate the credit, you take the $20 you got minus the $8 that you paid, and you get $12. And because these are equity options, the multiplier is 100, meaning 100 shares. So your income on this trade would be $1,200. This is the money you get to keep no matter what happens. But hey, look, this isn't a free lunch, and there are risks. The beauty of credit spreads is that you can trade them with small accounts, and you can limit your risks. There are 2 types of credit spreads. First, you have the bull-put spread, and for most brokerages, well, they're going to refer to it like that. However, some brokerages like Robinhood, they call it a put credit spread. Either way, they're one and the same. With a bull-put spread, investors believe that the stock is going to go up or stay above the strike price by expiration, so it's a bullish trade. And some brokerages call it the put credit spread. Same thing, different words. The put means you're going to be trading puts. The other type of credit spread is called the bear call. In this case, you might have guessed that the bear means you feel the stock is going to move down and stay below the strike price by expiration. For me, I prefer the original term as it acts as a quick reminder of the direction you want your underlying trade to go. And this is called the sentiment, bull or bear. So if you think that the underlying security is going to move up, consider a bull put credit spread. And if you think that the underlying is going to go down, well then in that case you're likely going to want to sell a bear call. During times of high implied volatility, your trades are going to be a little riskier, but you're going to get paid for it. Premiums are higher when there's higher implied volatility. So traders who sell credit spreads tend to make more money when there's volatility than when the markets are calm. To get started selling credit spreads, in both cases, the legs of a bull put or bear call spread get bought and sold at the same time. And with many brokerages, you can even trade the spread based on the credit amount. For instance, with Interactive Brokers, you can set a limit order for $1 credit or $100 in premium. This way, you don't have to worry about filling 2 individual orders. Alright, so let's look at a bull put spread. With a bull put spread, or a put credit spread, options traders take the position that the stock or the underlying security is going to stay above the strike price at or by expiration. In other words, the trader is bullish on the stock, and the premium or the income is what you get to keep no matter what happens to the trade. Not only that, your potential losses are capped in most cases. Let's take, for example, Microsoft. Here, we see that Microsoft is trading at $288. With a bull put credit spread, an investor could sell a weekly $285 Microsoft put option expiring on May 6th and collect $8.75 or $875 in income. I say weekly because weekly Microsoft puts expire on Fridays, where monthly Microsoft puts expire on the 3rd Friday of each month. At the same time, the investor can buy the $280 put, also with the May 6th expiry, and this one costs $7.25. So with this trade, the investor has a net credit of $1.50, or $150 for the trade that they get to keep no matter what happens. In fact, traders will want the options to expire worthless, so, thanks to time decay, in this case, they're going to want the stock to remain above $285 before expiration. If the stock moves below $285 before expiration, the trade's going to turn into a loss because it's going to be in the money. But the maximum loss is the difference between the strikes minus the premium. So in this case, it's $350. But here's a tip. Be sure to buy back your credit spread if it's in a loss position and it's close to expiration, because you don't want to risk being assigned. Now, the only problem with this trade is that the probability of profit is just 60%. Not bad, but it also means there's a 34% chance that we're going to face a total loss. And for me, that's too much. Now remember, the maximum loss is only $350 per contract, so it's not the end of the world. Still, if we based our decisions on no big deal, we'd probably run out of money pretty quickly. So what do we do? Well, we can move a little further down the strike prices. And in this case, I checked and I found that selling the $275 May 6th put on Microsoft and then buying the $270 put gave me a 75% chance of being profitable and a credit of 90 cents, or $90 for the trade. Now, you might be thinking, well, $90, not really worth it. But with credit spreads, small is good. With this trade, you get a 75% chance of earning that $90 with the options expiring in just a few short weeks. Now, you could even sell the 260 and buy the 255 strike, giving you an even better chance of being profitable. Of course, the higher the chances of profitability, the lower the income you are going to receive. And if that isn't enough, you can always sell more than one of these credit spreads. For instance, if you sold 10 of them, you'd be able to bring in 10 times the premium. But here's the thing. The further out of the money you sell your credit spread, the higher the chances you keep the money. Good, right? It expires worthless, and you move on. But you need to find a balance, because the further out of the money you go, the higher your potential loss. This is because you're going to be collecting far less credit with the same amount of capital at risk. So it's all about balancing risk and reward. Now, in case you're wondering, there's a tool you can use to find options trades based on chances of being profitable. It's called an options screener. And I'll show you how I use it and some basic rules of trading credit spreads after the bear call example. Now, the other credit spread is called the bear call, or the call credit spread, and some folks even refer to it as the poor man's covered call. Whatever you call it, the bear call strategy is a neutral to bearish position in the underlying security. In other words, when stocks are going down, well, this is when you're going to want to sell calls. Either way, investors who sell call spreads think that the stock will stay below the strike price before expiration. Let's look again at Microsoft. Looks like it went up a little bit, and now it's trading at $288. With a bear call, the trader will sell a call option above the current trading price and buy the same option with an even higher strike. So, the first thing we're going to do is pick an expiration date, because we want enough time to lock in our profit. In this example, I'll look at the May 6th weekly options once again, and I'll consider selling the $290 call option strike and then buy the $295. And in this case, the net credit is $2.05 or $205 for the trade. Now, in this case, as long as Microsoft stays below $290 on or before expiration, the trader gets to keep all of the premiums. You get to keep all the income on this trade. And like the bull put, the risk is the difference between the strike prices minus any premium. So in this case, it's $295. Of course, the chances of getting a profit out of this trade also aren't that amazing. It's literally just 53%. So you could look a little further out of the money for a better chance of profit. And for that, we could try the Microsoft $320 call option strike and then buy the $325. And the net credit in this case would be 21 cents or $21. In this case, as long as Microsoft stays below $320 on before expiration, you, the trader, will keep all of the premiums. And just like the bull put, the risk is the difference between the strike prices minus any premium, so in this case it's $479. Now, again, like I said earlier, if this particular options trade is going out of the money and you're in a loss position, you're going to want to buy back the credit spread to avoid being assigned. Of course, you might say that $21 to risk $500, maybe it's not worth it. But in this case, the chances of a maximum loss is just 9%. So there's that to think about too. The nice thing about credit spreads is that the risk to you and the brokerage is minimal. It's defined at the time of the trade. In fact, with a credit spread, the risk is usually the difference between the two strike prices minus any premiums received times 100. This is because the difference between the two strike prices would be the absolute worst case scenario should you buy back your credit spread. And of course, you already get to keep your income. Now, as a result, you're probably going to find that your brokerage is going to require the differences between the two strike prices to be your margin requirement, or they might call it your collateral requirement. But here's the thing. If you find your spread to be in the money at some point, you might get assigned. And if that happens, you're going to need to decide what to do. And more on that in a moment. Say you sold a call option with a $500 strike, and then you bought the $505 strike. For example, the difference in the strike prices in this case is $5. So the margin requirement, or the collateral, will be $500 per contract. But here's the thing. You collected this credit by selling this credit spread. And if the credit is, say, $100 or $200 per contract, well, that offsets any potential loss. After you sell your credit spread, you're likely going to find that it goes in and out of the money. Well, thanks to theta, the overall value of the spread will go down if the stock market or if the stock doesn't move, which is what you want. But if the underlying moves against you, you could find yourself with a spread that's in the money. And the closer you get to expiration, the higher the chances you'll get assigned. So if you find that your spread is in the money, go ahead and consider buying it back. To do so, you'd buy back the short leg and then you'd sell the long leg. And you could then sell another vertical spread with a similar credit a little further out. This is what's known as rolling your option. And rolling is an excellent way to just kick the can until you're profitable. Whatever you do, always pay attention to the chances of profitability, because in this case, you don't want to be greedy. Having said that, the last thing you want to do is get assigned. If you do get assigned, it's probably best just to sell the stock and move on to the next opportunity. When it comes to trading credit spreads, I have 7 rules. Rule number 1. Trade options on quality companies that you'd actually like to own. Number 2. Trade options with a higher chance of profit. Number 3. Target for at least a 10% return on risk. For example, you'll want a minimum 50-cent credit on a spread of $5 between the strikes. If you're trading something really far out of the money and you're collecting a few pennies, for example, you'll probably make money 99 times out of 100, but that one time, well, it could wipe out all the profits you made thus far. Number 4. Set a profit-taking order of about 70 to 80% worth of the credit. Or if you can't set that kind of order with your brokerage, say you collect $100 and you can see that you can now lock in $70 to $80 of it, well, go ahead and do it and move on. Number 5, attach a stop loss order on your trade if you can. Or if your trade is moving far away from you and the spread is now in the money, think about getting out around 50 to 80% of the trade's maximum risk. Number 6, watch the earnings dates. If you're selling credit spreads, you're going to want the expiration dates to happen before the earnings. And finally, number 7, use an options-friendly brokerage, one that doesn't charge high commissions and that allows combination trades and gives you access to data. I like Interactive Brokers, but it's not the only one. So that's how a credit spread works. Now, how do you find credit spread opportunities? I mean, if your plan is to sell credit spreads on 1 or 2 different stocks, then you can look at chances of probability on your trade within your brokerage's account app. Now, what if you want to scan for 500 companies or more? Well, to find these opportunities would take a lifetime. And this is where an options screener comes in. And for that, I like to use Options Samurai. By the way, big shout out to Options Samurai, who allowed me to use their platform free of charge to research this video. It's kind of like a Google for options trading in that you can plug in what you want and it searches the market for opportunities based on the criteria that you set. Not only that, they give you an Excel plugin, alerts, stock scenarios, and access to your own trade log. If you'd like to support the channel, I've also left a link to Options Samurai in the description below, along with a promo code that's good for a free trial and of course a nice discount. Here's how it works. So here I've logged in and I've set up a screener and I set it up for a bull put. I can customize the parameters that I want to search for. For example, I can set the implied volatility, volume, and of course expiration. Here I'm going to set it for about a month out because I don't want anything to expiring tomorrow. And of course, there's the most important piece, which is the possibility of max profit and loss. Here I want the profitability of max profit to be 85% or more. And I'm being conservative. And max loss, or otherwise a total loss, I'll set to 20%. Then I hit run scan and see what we got. Okay, so we have 5 possible trades. Let's look at this one here from Meta. Here we can sell the $180 strike expiring May 13th and buy the $170. You can expect to make about $1.03 per share or $103 per contract. Your maximum at-risk money is $1,000, so $103 is more than 10% of that, which is what you want. And the maximum loss probability is just 7%. Not bad. Next, we can also look at Netflix. In this case, the screener is suggesting the $290 May 6th put and buying the $270. This will generate $2.18 at the midpoint, and the chances of maximum profit is 86%. Of course, you can tweak the option screener however you like. And of course, it's got so many different option strategies to choose from, and so many different parameters that you can play with. So what do you think of credit spreads? Let me know in the comments below. And if you made a trade, let me know how it went. I love reading and responding to your comments. In the meantime, thanks so much for watching, and I'll see you in another video. Bye.